Hey, everybody, welcome back to the Loan Doctor Podcast, where we believe that doctors deserve better mortgage deals. Today, we're going to be breaking through a myth where most people have this misconception that putting down more is always better, and especially not as a physician. We're going to show you how, in some cases, it doesn't make sense to put more money down. There's a better way to actually get a loan and also invest your money long term so that you and your family can live the American dream. You see, as a physician, you actually have access to some more amazing products than most people don't. As a physician, I can actually offer you a physician loan where we can give you up to $1 million with 10% down and no PMI insurance. So let me just explain what is PMI insurance. It's private mortgage insurance. And what that is, it's an additional charge that we charge typically as a bank. If somebody puts down less than 20%, we need to actually cover that risk between that 10 and 20%. We're going to want to do that. And we're going to use a product called private mortgage insurance. And that insurance is designed to basically cover the risk. But we feel as though at a bank, and I've said this on other podcasts, that we feel as though physicians are less of a risk, so we're willing to take the risk for you, and we're going to waive that actual additional cost. So that means that you can actually you can buy a home with 10% down for $1 million. And if I was not a physician, I'm going to have to put down 20%. So you could start to see where sometimes putting down that extra money doesn't make sense, especially if you're a young family or if you have student loans out that you're trying to pay back. So what if I told you I can keep more money in your pocket and actually help you to make more money on the long run by purchasing a home? The first thing is most people think that the more you put down, the better, because it lowers the monthly mortgage payment. That's a great thing, but the challenge is when you're a high net worth individual and you're earning a tremendous amount of money, you actually may need the tax benefit. So for high income physicians and stuff like that, it's a little bit different. And it may be a different strategy. You may want to talk to your financial planner about that just to see the benefits of that. Instead of locking up your cash in the home in equity, almost better to be able to use that money. So if we're going to purchase a home and I purchased a home for $1 million and you purchase a home for $1 million, you put down 10%, I put down 20%. If that house goes up $100,000, okay, and you put up 100 and I put up 200, your return on your investment is 100%. My return on my investment is only 50%. That's right. That's because we base the actual return on the investment on the sale price of the home, not how much equity you put in it. And quite honestly, anything more than the required amount that avoids PMI, that money just sits there. It gets zero interest and it pays zero interest. It just sits there in the equity in the home. So what I'm going to show you a way that we can actually use the equity in that home and use that additional cash that you had. And we're going to show you how to make an investment with it that actually may fare better in the long run. So instead of locking your cash up in the home and the equity, what if you could actually secure a better mortgage rate and also invest some of that money to get a better rate of return? There is a smarter way to doing that. So I'm going to show you a way where we can actually maximize both the acquisition of the property with the least amount of fees, the least amount of interest on the loan, and actually give you the ability to invest some money and to save some money over a period of time. So the first example, let's just break it down and we'll try to make it simple for you. Let's take the example of, a physician is purchasing a home for 20% down. They're going to buy that property. And typically we would give them three options. We're going to say to them, hey, a 30-year fixed rate mortgage at, let's say 6 3/8, that payment's going to be about. So let's say we're going to look at three different products for you. We're going to give you three different options, typically when we're showing you loan options and payments. And the first one is going to be a 30-year fixed rate mortgage. And that 30-year fixed rate right now, today's rate was 6 3/8, and that payment is going to be an estimated $8,533 on $1 million loan. Now with 10% down. So if we're 10% down, we're going to be at $900,000 for the loan. On a 15-year fixed, it's going to be around 6 1/4. That payment is about $10,915. So the payment's slightly higher, even though the interest rate is lower, but it's over a 15-year period. So we're cutting the payment schedule in half. And instead of paying it for 30 years, you're going to pay for 15 years. So what's the in between, and how do I get the lowest interest rate, the least amount of risk? In my professional opinion right now, we've been talking to a lot of physicians about a 7-1 ARM, which means that loan is fixed for 7 years. And at year 7, it's going to start to adjust every year after that. Now, bear in mind, I'm going to say this very openly. You do not want to be in that loan in year 7. Again, you do not want to be in that loan in year 7 because the bank has the ability to raise that rate typically by 2% on any given year. And granted, whatever they give you that rate for to begin with, it's almost inevitable they're going to raise the rate the full 2% based on whatever the index is that they're using. So here's the funny thing is on the 7-1 ARM, right now, that rate is 5.875, and that payment is $8,203. Now, compared to the 30-year fixed, $330 difference. That's a big difference. It's a lot of money. Over 12 months, that's almost $4,000 a year that you're going to save. So even if you were to say, hey, I'm going to have to refinance that loan, if you took the savings each year for 7 years and you put that money aside, you're going to have plenty of money to do the refinance and to cover the refinance on the loan. So at first glance, when we start looking at these products, most borrowers are thinking, hey, let's go with the 30-year fix. It's predictable. We know what we're doing. But here's the funny thing on the 7/1 ARM, it's actually your best value. Over time, you're going to save about $23,000, $24,000 within the first 6 years versus doing a 30-year fixed rate. In addition to that, what we're going to do is we're going to show you a program where you can do some relationship banking, like with our bank. We can actually lower your rate with a small deposit into our wealth management account and basically create a wealth management account to where we know you're an affluent borrower. So we're going to help you to build your wealth over time. The other thing is that it gives you more flexibility and more cash when you need it most, when you're in the beginning stages of your life. A lot of times our physicians become partners and they start to get quarterly payments for bonuses, or they start to get large chunks of cash in short periods of time. And with our company, we're one of the few banks that will actually recast your loan. So you can actually take a chunk of cash, let's say $100,000 bonus, and you say, hey, I want to put this toward the principal on my loan. You would call up our bank and we would actually put that deposit directly toward the principal on your loan. And when we do that, for about $250 fee, we're going to recast your payment based on the new principal amount. So we're going to actually reduce your payment based on the additional principal pay down that you did. Not all banks do that. We actually do that, and you can do that as many times as you want. There is a fee for it because we have to recalculate the payments and all that stuff. But the bottom line is there's options out there to help you to reduce the payment on the mortgage, and there's better strategies nowadays to help you as a physician specifically to actually save money in the long run. And it's actually, the 7/1 ARM is a great product for young physicians that are partners or surgeons where they're going to get large chunks of cash. The other thing that we've talked about in the past is if you're a surgeon or if you're somebody that is put at risk by doing your job, you may want to consider putting that house into a revocable trust when you purchase it versus purchasing in your own name so that you protect your assets, protect your personal assets and your family assets from somebody trying to sue you and take that. So here's the next interesting thing. Let's just say, let's get a little more fundamental with this. And let's say you deposit $100,000 into our wealth management. That's going to give us the ability to give you what's called relationship pricing. Because you're giving us some money and you're putting it in our depository bank, you're going to be able to invest that money and you're going to have a wealth manager that's going to guide you through your investment strategy. And that, I'm not here to talk about that. I'm not a qualified investment banker or anything like that. I'm just telling you that money sitting in a property that's getting zero interest and paying zero interest, anything more than zero is better. Let's say that you're able to, instead of putting down 20% and $200,000, let's put down 10%. We'll put 10% in the property and we're going to invest 10%, that other $100,000, and we're going to put it in a wealth management account. Our company at this time offers what we call relationship pricing. We're going to give you 1% to help buy down your interest rate. So when you see an interest rate that says, it's 6.5% with 50 basis points or 50.5 points that you have to pay, we're going to give you up to 1% to help buy down that rate. On $1 million loan, that's $10,000. That's a lot of money to help you buy down the rate. In addition, at least at our company, we do is if you deposit between $100,000 and $250,000, we're also going to reduce the rate, whatever the rate is that we buy down to. Let's say we buy it down to 6 1/8. We're going to give you 1/8 of a point off the rate in addition to the helping you to buy down the rate initially. So if we buy down that rate and we give you a rate at 0 points at 6 1/8, and you gave us $100,000 to 250, we're going to also reduce that rate by another 1/8 of a point. That's a big deal. It saves you a lot of money over time. But here's the real kicker. What if you're actually what if just for argument's sake, the money that you put into your wealth management account, you were able to get about an 8.5% return? Now, is that aggressive? It is, but it isn't. And again, I'm not quoting rates, but I'm just trying to give you as an example of what this looks like. And typically that's a pretty conservative rate for a high net worth individual to get on an investment account, depending on whatever the market is doing. Okay. In past years, on average, they were seeing 7, 8, 10, 15%. I don't know what's happening going forward. So I'm going to be more conservative and I'm going to say, hey, let's just use 8.5%, which is fairly conservative. And you put that same $100,000 into an account. Over a 6-year period, you're going to generate over $66,230 on that money. Just by depositing that money. And if you were to get an 8.5% return, that's a huge amount of money. That's $66,000 that if you really wanted to, you could refinance your loan and actually put that directly toward the principal on the loan. So that's cash that you can invest, use for the future. It's yours. You do whatever you want with it, and it's not trapped in a property. So why this works for physicians specifically, okay, is because the physician loan has, like I said, the borrower can borrow up to $1 million with no PMI insurance, which is a huge savings. And then the other thing is you have the flexibility of handling that, your other debts. And let's say you have student loans and stuff, you can actually take that 66,000 and dump it directly into paying your student loans and pay them down in a larger chunk, get you back to zero faster. Here's the other thing too is not only are we lowering your down payment, we're also going to give you different ways to actually structure loans. And because you're a physician, your income grows over time and has a flexibility in the loan structure that you want to grow with it. So a strong investment strategy is always beating just getting a loan. I love to say it this way is we're not just slinging loans. We're not just giving you a loan to go buy a house. Our job is to help you to find the best possible loan product with the least amount of fees, the lowest possible interest rate, and the highest bank credits to help you to grow your money, not to actually just spend money. So here's the big takeaway. Putting down more money isn't always the smartest move, especially if you're a physician. With our company, we have some exclusive loan products and also some relationship banking products that make it super advantageous for you to consider other options. This is it's a far different conversation than your traditional conversation of, hey, put down as much as you possibly can and let it sit in your house until you want to sell that house 30 years from now. In this day and age, I've met very few people that stay in the same home for 30 years, especially physicians. What we're here to do is to help you. We believe that physicians deserve better deals. We believe that you need loans that are structured for your income and the way you generate income. And whether you're a first year student or you've been around for 20 years, I'd love to talk to you about getting your next house. My name is Sean Schaus, aka The Loan, and I've been in the industry for 25 years. I've helped people negotiate, buy, sell, invest in over 2,000 properties when I was a realtor. And now I'm what they call a recovering realtor. Okay, I haven't done a real estate transaction on the sales side in about 3 or 4 years. But prior to that, we helped people do over $1 billion in real estate deals. Now I actually help people structure their deals. And I want to show you how to structure the best deal for you and your family and your income and show you how to build wealth over time. We'll see you on the other side. Sean Schaus, aka The Loan Doctor. We'll see you on the other side. Top producing loan officer, the 5th largest bank in the United States. We'll look forward to seeing you. Hey, if you like this, please get back to me. Comment down below. Set up an appointment with us. We'll look forward to talking to you. Have a great day. Thank you.